a straddle is quite a straightforward to understand and implement. If we summarize, we buy calls and puts, and each leg has a limited downside. Hence, the combined position also had a limited downside and an unlimited profit potential. It's like placing a bet on the price action each way. You make money if the market goes up or down. The direction actually doesn't matter here. But let's think it over again. If the direction does not matter, what actually matters in the strategy? Do we actually end up making money always in the strategy because the market will either move in some direction? No. Volatility is a very important factor which matters quite a bit when we implement a straddle. A fair assessment on volatility serves as a backbone for the straddle's success. On the face of it, a long straddle looks great. Think about it. You get to make money whichever way the market decides to move. But you need the right volatility estimate. So what can actually really go wrong with a straddle? Well, two things come in between you and the profitability of a long straddle. The first point is the theta decay. All the factors being constant, options are depreciating assets, and it particularly hurts long positions. The closer we get to expiration, the lesser time value of an option. We've already discussed this in our previous videos. Time decay accelerates exponentially during the last week before the expiration. The second point which we need to keep in mind is large break-even points in a straddle. In the example which we just discussed, the break-even points were almost 200 points away from the strike price which we entered. The lower break-even point was 10,144 and the upper break-even point was 10,556, considering the at-the-money strike price which was 10,350. So in percentage terms, if we calculate, the market has to move approximately 2% either ways to achieve break-even, which means that the time we initiate the straddle, the market or the stock has to move at least 2% or higher or lower for us to start making money. And this move, remember, has to happen within a maximum of 30 days. Further, if we want to make a profit of at least 1% on this trade, then we are talking about 1% move over the above of 2% on the index. So such large move on the index is quite a challenge, obviously. So keeping these 2 points plus the volatility factor, we can summarize what actually needs to work in our favor for the straddle to be profitable. The first point is that the volatility should be relatively low at the time of strategy execution, and this volatility should increase during the holding period of the strategy. Secondly, the market should make a very large move. The direction of the move, however, does not matter. And the expected large move is time bound. It should happen very quickly, well within the expiry period. So we can say that the long straddles are profitable when it is set up around major market events, and the impact of such events should exceed over and above what the market is expecting. Let us take an Infosys result as an example. Here. Say the market expectation is flat and the revenue guideline for the coming few quarters will not be too high or too low, and the actual outcome of the result as expected, Infosys announces a flat revenue guideline for the coming few quarters. Now Now if we set up a long straddle in the backdrop of such an event and its expectation, and eventually the expectation is matched, then the chances are that the straddle will not generate a positive profit and loss for us. This is because around major events, volatility tends to increase, which tends to drive the premium very high. So if we are buying an at the money call and put option just around the corner of the event, then we are essentially buying options when the volatility is high, and when the event results are announced and the outcome is known, the volatility drops significantly and therefore the premiums. This naturally breaks the straddle down and the trader will end up losing money as he has bought at high volatility and now selling it at a lower volatility. However, imagine a situation that instead of a flat guideline, Infosys announces an aggressive revenue guideline. So this would essentially take up by the market as a surprise and drive the premiums at a much higher value, resulting in a profitable straddle trade. So this means that there's another angle to straddle. Our assessment of the event outcome should be better than the general market assessment. We cannot set up a straddle with a mediocre assessment of an event and its outcome in accordance with the general market assessment. So long straddles are to be set up around major events, and the outcome of these events should be drastically different from the general market expectation. So with this, we can conclude long straddle strategy in this video. Thank you.